Hello, how everybody's doing? This is Gus Tucker. It's Financial Freedom Fridays. Hope you are doing well today. I'm excited to be with you. Got a lot of stuff to cover and got some great information. And get your pens out, get some paper out or something that you can take notes with, because for the remainder of this year and next year, we're going to be going through a lot of information, and it's information for you to apply. It's not just information to stick in your head, but it's information for you to apply. As I've been looking at this, I'm like, wow, I need to update some stuff as well. So I'm gonna bring this presentation up, and we're gonna get to it here pretty quickly. Okay, so I'm gonna click through this first part, and we're gonna get to here. One of the things I'd really encourage you to do is to get this workbook. It's something that we're using, and it's a 90-day journey, and now it's a 60-day journey. It'll be November and December. It's to put your strategic plan together for 2024, to really think through what is it you're wanting to accomplish in 2024, to really get your goals and objectives in place, spiritually, financially, physically, in every way possible. I really encourage you to get this. It's called Rebuilding My Temple, a 90-day journey. It's something we're using at our church that they developed. Regardless of your belief system, it will be something that would be tremendous for you to. A life well lived is a life that's analyzed and you think about. Okay, and it's good to, at the end of the day, have a record of what you've been thinking about, decisions you've made, goals that you want to accomplish, and things like that. So I really encourage you to get that. It's $5. It'll be the best $5 investment you've made. Okay, we talked about, as we jump off into next year, we're going to be talking about the 4 levels of wealth. First, creating financial stability, then security, then freedom and abundance. We'll be defining those, talking about what they look like, and how to have a plan for making those happen in your life. And then these are 8 financial breakthroughs. We're going to go through these in detail. There's going to be a financial plan developed around these to get you on track to make these 8 financial breakthroughs, because these are things that every one of us is going to face no matter what. Okay, we need to be financially aware of our financial DNA, how we manage money. We need to protect our families from outside threats that could cause us to lose income, have our identity stolen, or through illness or death, have our financial legacy impaired, managing our cash flow today, managing our debt. Debt's not necessarily bad if it's the right kind of debt and you're doing it for the right reason. So we're going to look at debt to income ratios, how to manage your debt, how to manage your credit score. We're going to look at liquidity, having money for short-term financial needs, but also having money for business opportunities. Things may come up that you want to take advantage of, but if you don't have the money available or access to it, that could be a problem. Your future income and net worth, make sure we're managing that. We're going to talk some about that today. Have a legacy and a succession plan. What are you doing to make sure your children and your children's children are going to be better off than you are? And then lastly, accountability. Who are you accountable to for making these things happen? Because if we're not accountable to somebody, somebody will hold our feet to the fire a little bit. Like I had mine done today. It doesn't feel that good, actually, but it's something that you need. Okay, I know I do. Okay, 4 key numbers to measure. Okay, 1 is your monthly cash flow margin. And so you got to have I would encourage you to have a budget or income statement. And so where you have your income that comes in and your expenses equals your cash flow. Your income minus your expenses equal your cash flow. Do you know what that is every month? It's either positive, negative, or it's about even. Okay. And then to look at, okay, what do we really need to be spending? Those are your fixed expenses, things you have to pay, like a mortgage or a rent payment, a car payment, insurances, utilities, food, things like that. Those are fixed expenses. They're going to happen every month no matter what. then that's your non-discretionary cash flow. So that should be a lower number. And then if you look at those two numbers, that's the number that you could choose not to spend if you didn't have to. Total income minus all your expenses is your cash flow. Total income minus your fixed expenses is what you have to spend. And then that'll show you a cash flow number that should be higher. The difference should show you some areas where you could either cut down or reallocate money, which brings us to the second number. What's your monthly saving plus your monthly investment number? Savings are things you need liquid, less than 5 years. Investments are things that are going to be in an account or in an investment for 5 years or more. Your goal, I would encourage you to have a goal of that you're saving and investing a total of 30% of your gross income. Man, that sounds like a lot, Gus. Well, if it sounds like a lot, what does that say about your thoughts about savings and investment? Okay. This is a rule of thumb. Poor people save 10% or less of their money. Middle class between 10 and 20%. Wealthy over 30%. Okay. That's just the way it is. If you go back and look at your history and you look at how much money you have saved right now, are you excited about it? That you have saved and invested? Are you excited about it? If you are, that's great. If you're not, take a look at what percentage of your gross income your current monthly savings are right now. And then take a look at your view of money. Poor people see money as something they need to pay their bills. Okay? I need money because I got to pay my bills. I got to pay all those bills I just mentioned. Middle class people look at money as something they need to buy the things that they want so they can have a nicer life. Wealthy people want their money to make them money, right? And then they pay for the things they really, really want out of the interest that they're making. The interest that their money's making for them, the money their money's making for them. So look at your savings and investment numbers, okay? Third number, your net worth. What do you owe from what you own? Net worth is what you own minus what you owe. So you buying a home or you buying real estate? What's the value of that real estate over and above the mortgage? What's the value of your investments? Anything you own, what's the value of it? Then subtract out what you owe on mortgages and other debts. That's your net worth number. You want that number to be increasing every year. But it won't happen by accident. Okay, we got to work on that. Then your financial independence number. I don't know what retirement means to you, but one way I want you to at least think about retirement, it's an age where you can stop working for money, where you don't need to work for money anymore because you either have investments or businesses or real estate that's making you money so you don't physically have to go out and make money anymore. Okay, so what's that number that you want to have coming in every month? And then how are you going to make that happen? Is it going to be from investments? So you're going to have a certain amount of money invested at a certain rate of return, and that's going to get you your number. Or you're going to have businesses that are paying you cash flow passively, or you're going to own real estate. How are you going to do that? How are you going to create that financial independence number? Or you could be depending on pensions or Social Security or that. I mean, that can work as well. Just depends on what your goals are. So those are the four things. I'm going to go back. Your monthly cash flow margin, we need to know what that is. So calculate that. Your monthly savings plus your monthly investment number. What's the percentage of your income that is? Your net worth, what you own minus what you owe, and then your financial independence number. Those are four numbers that we need to know and we need to measure, okay? You guys got that? Did you write that down? Your cash flow margin, income minus expenses equal cash flow. And then total income minus total fixed expenses is non-discretionary cash flow. You can take a screenshot, okay? And then your monthly savings plus monthly investment number. What percentage is that of your income right now? Net worth, what you own minus what you owe. And then your financial independence number. How much do you want coming in and by when? Okay? We got to hurry up. Now, we hope you got the book, Power Zero. Give me comments on whether you got the book or not. This week, you're supposed to read chapters 1, 2, and 3. We're going to review it real quick, 1, 2, and 3. And then next week is chapters 4, 5, and 6. 4, 5, and 6. Okay. So chapters 1, 2, and 3, The Power of Zero by David McKnight. And the purpose of this is how to get to the 0% tax bracket and transform your retirement. In other words, how to retire and pay zero in income taxes. How many people would like that program? Well, you got to start planning that right now. And David McKnight talks about how to do that in this book. So the first chapter in the book is called A Gathering Storm. And he's talking about in here the issue of taxes. And will income taxes be higher or lower in the future? What do you think? Will they be higher or lower? Send me a comment. Let me know. Do you think they'll be higher and lower, and why? And there's a 4-letter clue to what the answer very well could be. I can't guarantee this is going to be the answer, but this 4-letter word is a clue. What do you think the 4-letter word is? Put that in the comments as well. What are the 4-letter words? Well, I'm going to give you a second to figure out what that 4-letter word is. But no, it's not that. It's not one of those 4-letter words, okay? The 4-letter word is math. It's a math problem. It's a math problem. Why am I saying that? Well, let's look at some numbers. In 1935, there were 42 workers for every Social Security recipient. At 1960, it was 5.1 people were working for everyone that was getting a Social Security benefit. So it went from 42 to 5. And now it's down to 2.6 people are working for everyone that's receiving a benefit. Why am I telling you this? Because the ones that are working are the ones that are paying into the system. Think about that. If that number's going down and there's fewer and fewer people paying into the system, and it's already going to run out of money, what's going to happen? It's going to run out of money faster. Then let me ask you a question. How does the government then get money back into that system? And some other systems I'm about to show you. How do they get money back into those systems? And oh, by the way, we've got liabilities for these and other programs that aren't even funded right now, trillions of dollars. So if the number of workers going to Social Security is going down and the amount of liabilities we have is going up, what's the government going to have to do to try to have more money? They got to tax the remaining people. And they're going to have to tax them more. Okay? Look, there are 4 programs that take up over 70% of the government's budget. And you can go to this website. It's called usdebtclock.org. US debt, DEPT, clock, CLOCK.org. You can go there and you can look up the cost of these 4 programs like I did. And look at what the total budget is right now and our total income. And you'll see that over 70% of the money that is collected for taxes goes to Social Security, Medicare, Medicaid, and paying the interest on the debt we have. It's over 70%. So what's got to come out of the rest of it? Everything else that our company does. Department of Defense, Homeland Security, Parks and Rec. Every other thing that there is comes out of the rest of that 20-some percent. These 4 programs drive over 70% of the budget. They call them entitlement programs. At least 3 of them are. This is a concern. If you're a person that's thinking about what's going to happen on taxes down the road, they're probably going to go up. Why? They have to fund these programs. What would happen if you stopped Social Security or you stopped Medicare? There'd be an uprising in this country. It's a math problem. Taxes are going to increase to cover the cost of these programs. So if you're going to retire in the future, do you want the government taxing your retirement? Question, do you want the government taxing your retirement? Look, our highest tax rate now are in the 30s. They've been high as 90+% in the past. Our highest tax rates have been as high as 90% in the past. So they can go up, y'all. So be careful. So that first chapter is called The Gathering Storm, and it's all about what's happening with our government and its spending. So make sure you read that chapter close. The next one is about the next concept. It talks about the 3 tax buckets, and there's basically 3 tax buckets: taxable, tax deferred, and tax advantaged. Taxable are usually things that you want to keep liquid because they're like CDs, checking accounts, savings accounts, those kinds of things. When you put your money in those, it's because you need the money liquid, so you can either cover unexpected expenses or money you use to pay bills and things like that. Okay, but that money's taxed. So any interest you get on that red box, that red group, you're going to pay taxes on it today, right now. You're going to get a 1099 at the end of the year, and any interest you got on that tax bucket, you're going to pay tax on it. Then you got tax deferred. That's most of people's retirement plans, 401s, 403s, 450. And then tax advantage or tax free is really 2 things: Roth IRAs and the cash that accumulates in a life insurance policy. Well, you need to have a strategy for these 3 tax buckets. You got tax now, tax later, tax never. And these are the kinds of things that fall under each one of those. Tax now are things like savings accounts, certificates of deposits, bank CDs, money markets, stocks and bonds, and mutual funds. Tax later, 401, 403Bs, like IRAs, SEP IRAs, savings plans, annuities, pension plans, anything that's called a qualified account is qualified for one of the tax laws where you get a tax break today, which means they're going to tax you down the road and probably at a higher rate. Tax never are Roth IRAs, the cash accumulation in a life insurance policy. If you have a 529 plan, or you get proceeds from an insurance policy for long-term care or critical or chronic illness, those things typically aren't taxed. Tax now, tax later, tax never. But you need a strategy for your taxable bucket. How much money should you include in the taxable bucket? That also includes your taxable income, because the more money you make, it drives you into a higher tax bracket. It's not a bad thing. But what if you could have your income continue to go up, but your tax bracket is 0? Would that be better? Then your income goes up and then your tax bracket goes up too, versus your income goes up, but your tax bracket doesn't go up. That'd be even better, wouldn't it? So you need a strategy for that taxable income. You pay taxes on the account's growth every year, you get a 1099. The ideal amount to keep into that taxable bucket is just money you need for unexpected expenses. Probably somewhere between 3 to 6 months of income or expenses. Okay, why? Because if you keep a too large of amount in there and you're going to make interest on it, you're going to get taxed on it. And that'll also count towards what's called provisional income on Social Security. Have you guys ever heard of that? Provisional income? Do you know you can get taxed up to 85% of your Social Security check that you get? If you still work and make money, that creates a taxable income. It has to be claimed on your taxes. You can get taxed on up to 85% of your Social Security. So we're going to talk about that bucket a little bit more. The next is the tax deferred bucket. It's typically IRAs, employer retirement plans. The contributions are tax deductible. When you take money out, it's considered ordinary income. If you pull money out of a 401k and you're under 59 and a half, you're not only going to pay your regular tax, but you're going to pay a 10% penalty. If you're over 59 and a half, you won't pay the penalty, but you are going to pay to take that money out. So wait a minute, I've been saving this money my whole life, and now that I'm ready to retire and I go to take the money out, you mean the government's going to tax me? Yep. And you need to understand what your tax rates are going to be in the future, because 4 of your biggest tax deductions probably are going to be gone by then. Mortgage interest. If your house paid off, you can't deduct the mortgage, can you? Child tax credit. Your kids are going to be out of school down the road. Those tax credits you used to get are not going to be available. You're not going to be putting money into a retirement plan. You're going to be taking money out of a retirement plan. So that deduction isn't going to be there. And probably because your income went down, maybe it didn't, maybe it did, but it's probably going to impact how much you give to charity. So your 4 biggest tax deductions aren't going to be there. So one of the things you need to be thinking about when you're thinking about retirement is what are my tax deductions going to be? Because we're going to be talking about that in a second. Now, let's talk about this provisional income. So half the Social Security benefits that you get, they're counted towards your provisional income. So let's say you get $2,000 a month. That's $24,000 a year. $12,000 that's going to be counted towards your provisional income. So that means if you're single, that leaves you between $13,000 and $22,000 to make an additional income, and then up to 50% of what you get from Social Security can be taxed. If you make $34,000 or more, up to 85% of your Social Security can be taxed. Wait a minute. I paid all this money into my taxes, and when it's time for me to get it, I can pay tax on it again? Pay tax on the stuff that I got because I paid my taxes to get it? You're going to tax me again? Yep. Yeah. So that's what it is for single people. For married people, it's 32 to 44,000 income to get 50% taxed, and anything over 44%, you're taxed by 85%. Now you can double check these numbers to make sure they're still relevant, because they do change from time to time, but the law hasn't changed. Your Social Security can be taxed. And you live in Illinois, there are some states that don't tax Social Security. I live in Illinois, and it's not one of them. Okay? But if you're going to retire somewhere, that's something else to consider. Does the state tax me on my Social Security? Now, the tax deferred bucket. What you want to do is manage the income for this account. So when you retire, you need to understand your remaining tax deductions. So you can understand, when I file my taxes, am I going to file the standard deductions, or am I going to file itemized deductions? And then you're going to do income planning. Where's my income going to come from? Is it going to come from a place where I'm a W-2 and they're going to be taking my taxes out for me? Or am I going to be more of a 1099 self-employed business owner type? Maybe I'm not. Maybe I'm a 1099 person. Well, what are your deductions going to be? Where your income going to come from? What are your deductions going to be? And then they have something called required minimum distributions. When you get a certain age in your 70s and you have a qualified account like a 401k or 403b, 457, or traditional IRA, the government forces you to take your money, and they're going to then charge you the interest against it. Okay? Yeah. Does that make sense? They're going to make you take out a certain amount, and then they're going to charge you taxes on it. That's for your R&Ds. Now, your goal for this tax deferred bucket, we'll get more into this down the road, is to keep the income that comes in into this bucket at a rate where the deductions you have wipe out the income and you pay zero taxes on it. So you don't hit the threshold of what it takes to pay tax on that tax deferred part of it. So you keep a certain amount in your taxable bucket, 3 to 6 months income. In your tax deferred bucket, you figure out what your deductions are going to be, and look at the tax rates and the tax laws, and then see at what level can you have income come in. When you take your deductions, you won't owe any money. That's how much money you want coming out of the tax deferred account. So that also says how much you should plan to put into it to hit that number. And we can help you figure that out. And the last thing, the tax advantage or tax-free segment, we're going to cover that during our next get together. Okay? So the question is, what are your 4 key numbers? Do you know what your 4 key numbers are? Well, Gus, what were those numbers? Okay, I'm going to skip back to it real quick. Go back to your key numbers. I think they're right in here. Your monthly cash flow margin. Do you know what that number is? Prepare to know what that number is. Your monthly savings plus your monthly investment number. What percentage are you at right now? Number 3, what's your net worth? What do you own versus what you owe? Get Rocket Money. It'll help you figure all this stuff out like that. Your financial independence number. What is that? Okay. So we're going to go down back to the slides we're on. I think we're right in this neighborhood. Yep. What's your taxable account strategy? How much should be in 3 to 6 months that you're keeping in, CDs or a savings account or a checking account, that kind of thing. What's your 3 to 6 month number? Okay, that's the taxable account strategy. What's your tax deferred strategy? This is something maybe you're going to need to sit down with your accountant on or work this through, because how much money are you going to have in your 401k when you're ready to retire? And how much income are you going to take out of that? And then based on that, plus half your social security number, what tax situation are you going to be in? You're going to want to understand that so you don't get surprised and think you have one amount of money coming in when you retire and you have another. Okay? So next week, we're going to read chapters 4, 5, and 6 in The Power of Zero. It's called the Tax-Free Bucket. That's chapter 4. Chapter 5 is about the LIRP, the Life Insurance Retirement Plan. What the heck? Life Insurance Retirement Plan. What is that about? Well, we're going to cover that next week. And then the tax sale of a lifetime. So get the book, The Power of Zero by David McKnight, and get up to chapter 6 by the time we get together next week, and have your 4 numbers done and what your taxable account strategy is and what your tax deferred strategy is. If you got questions, reach out to me at financialfreedomfridays@gmail.com, financialfreedomfridays@gmail.com, or you can text me at 312-569-0757. 312-569-0757. Okay, guys. So we'll get together next week and see where you're at on your road to retiring with the 0% tax bracket and also minimizing your taxes along the way. Does that make sense? Like, that sounds like something you ought to do. I hope so. Y'all take care. Bye-bye.